Welcome to the Retirement Evolved podcast with certified financial fiduciary Adam Bruno.
And we're back. Welcome to another episode of the Retirement Evolved podcast.
Woo!
Okay, cool. I figured out which button it was,
That's
Lauren.
great, Adam.
All right. Of course, I am joined by the one, the only, the way this all works, Lauren Trolson.
Thank you very much. And hello, everyone.
Yeah, and Lauren, I'm excited about today's topic. It's one that can really make a difference for our listeners, wrapping up the year here. Why don't you walk through what you have planned for us here?
Sure. I'm excited too. This is something we're going to talk about because it's the perfect time of year to talk about it, which is year-end tax saving strategies. Perfect time to take action. Make sure your financial house is in order before the clock strikes midnight on December 31st. We talked about in the last podcast, Adam, with Chris, about the golden years.
Oh, that's right. Tell me you figured out what that means.
Yes. So I did a little research, and golden years typically refers to the later stage of life, often associated with retirement, when individuals have more time to enjoy leisure activities, pursue personal interests, spend time with family and friends. It conveys a sense of freedom, fulfillment, and opportunity to relax after a lifetime of work and responsibilities. The term golden obviously suggests something valuable.
Right. So that is something valuable now. So you've reached the golden, well, it used to be the brass ring on the merry-go-rounds, right? Now it's the golden ring. Yeah. All right. So, the end of the year, we know all of you are probably feeling it. You get the holidays, it starts to get hectic. Then you get the family events. We say family events, but what we really mean is family drama because there's always something going on, right? But it's also, unfortunately, not to pile on, it's the last opportunity to take advantage of some key tax saving opportunities. Today, we're going to explore how you can keep more of that money because let's face it, money makes everything a little bit better. So even through the family drama and the hectic schedule. And, set yourself up, most importantly, for success for next year.
Great. Yeah. Well, let's go ahead and kick some things off here. Let's start with deductions. Adam, first thing people should look at when they're trying to reduce their taxable income.
Great question, Lauren. There's so many answers to that question, but let's focus on what we can control about that, right? So the first step is to determine whether you'll take the standard deduction or you're going to itemize. For 2024, the standard deduction is $13,850 for single filers and $27,700 for married couples filing jointly. If your deductible expenses, like your mortgage interest, your state and local taxes, charitable contributions, exceed more than those amounts, itemizing could save you a little more. But the problem that we often have is we always think, well, the deductions aren't going to beat the standard deduction. I don't have deductions that are more than $27,700. So I think, it's probably important that we talk a little bit about that. What do you think, Lauren?
Sure. Yeah. So a little bit about overlooked deductions people might miss. Like we're talking about mortgages, but what people sometimes they forget about medical expenses.
Exactly. If your out-of-pocket medical expenses exceed 7.5% of your adjusted gross income, you can deduct the amount over the threshold, right? Another one is educator expenses. Teachers can deduct up to $300 of unreimbursed classroom supplies, even if they take the standard deduction.
$300
yeah,
for
wow,
teachers.
What a gift.
It's,
I know.
Yeah, really. I mean, just... Adam, you know this, but my mom just retired this past year after 41 years of teaching.
We retired her, I remember.
We retired her. Yes, we did. And, it's got to be just such, kids today are just crazy. But can you imagine, that's what you get, $300 for the year to fill your classroom. I know that they ask, the kids to bring stuff in, but $300.
Yeah, even when I was teaching, I spent a lot more than $300.
Yeah,
it's just terrible.
I know, my sister-in-law, Callie, she's a teacher as well. And she, would go and she'd get all this extra stuff because she wants kids to have a fantastic experience. And she was very creative with everything. But
very creative. Drove your brother crazy.
My gosh, stop. No, but she was nominated, I think 3 years in a row for Teacher of the Year, Golden Apple Awards. And I know she spent some of her own money doing that. But back to deductions here.
I will say one more thing about teachers. If you're listening and you are a teacher, we've got your back. Not only teachers, but firefighters, civil servants, police officers, because let's face it, they're doing the hard jobs, right? My job, I love my job, but it's not exactly like it's rocket science, right?
Yes.
So, this is important. Just want you all to remember, you don't have to have millions of dollars when you retire to make it a great retirement, right?
Yes. And after all you've done for the community and for everybody else, you deserve a fantastic retirement.
That's right. That's right.
So
It should be platinum years.
It really should. It should be platinum. Absolutely. Yeah. So, Adam, going back to this, how do charitable contributions fit into this?
Well, charitable giving is a big one, right? Cash donations to qualified organizations are fully deductible if you itemize. But don't forget about non-cash contributions like clothing, household items. I know we have families that have given churches a car before or something like that. So just make sure they're in good condition and always keep the receipts. If you made large contributions this year, consider a donor-advised fund to potentially deduct the full amount now while giving over time. And the other thing that I can't stand, and this is, when I say I can't stand, it's because the IRS really gets you with this one, right? So let's say that somebody is 70 years old, right? And heck, let's say 72, right?
Okay.
Let's say 72 or 73 when they take their RMD. Yeah, for the RMD, right? So, and it doesn't really matter. You can start this when you're 70, but the bottom line is, if you give $6,000 a year to your church, say $500 a month, that is not deductible because it still falls under the standard deduction, right? What people don't realize, though, is you can do a qualified charitable distribution. It's called a QCD, okay? And it starts at age 70. You can actually have, wherever your IRA is held, let's say it's held at Schwab, you can have Schwab cut a check to the church or the charity directly from your IRA. And then it's tax deductible, right? Because what's going to happen is it's taking away from your future required minimum distributions. It's tax-free for you. It's tax-free for them, and everybody wins.
I was going to
rather than taking the RMD, putting it in your bank account, and now you're donating from the RMD. Right. You didn't really see any tax benefit from it.
And I was going to say, a lot of our families, they reinvest, their RMDs. But would that kind of substitute that so that they wouldn't have to pay taxes on the reinvestments?
Well, I think the big key there is it's not necessarily about the taxes on the reinvestments. It's about the fact that you paid tax on the big amount of money.
Okay.
Oh, yeah, I see what you're saying here. So when because then if you were going to reinvest it anyway, you would have had to pay taxes
You would have
had
to pay taxes on that.
So yes, it kind of eliminates that double dip from the IRS.
Yeah, that's nice. And it's a write-off. Yeah, so that's great. Yeah. Wonderful. Well, let's move on. Since we're talking about IRAs anyways and RMDs, let's move on into these retirement accounts, which are a major opportunity for year-end tax savings. Adam, what should our listeners know about contributing to their IRAs or 401ks or 403bs?
The first thing you should know, especially if you're still working, and maybe some of you that are retired remember this, you put that money away and you throw it into the IRA or the 401k. Very important to remember that if you try to take that money out before you're 59 and a half, you're subject to the taxes, but you're also subject to a 10% penalty for taking it out. So understand why you're using it. You're using it now to save taxes now, as opposed to, and you're kind of kicking that can down the road. So the risk with that is we don't know what tax rates are going to be by the time, you have to take out the RMD or you start taking that money out. But the fact is that most of us, while we're working, we want to take advantage of a lot of that tax deferral because of the fact that it can save you the taxes now. So just understand before we go any further with this, it's not like you're not paying taxes. You're going to pay them eventually. But retirement accounts are a double win strategy in most cases. For IRAs, if you meet the income limits, your contributions are tax deductible, right? So that reduces your taxable income for that year. That's what I was saying. That year you're saving yourself that money. The limits for 2024 are $6,500 if you're under 50 and $7,500 if you're 50 or older. So that's kind of a maximum strategy. So for example, if you put money in your 401k at work, sometimes you max out the 401k at work. Every company's a little bit different. I think we can send you the 401k schedule because it's higher, but there is a maximum.
It's
22,500. Yeah.
But if you're over 50, it's 30,000.
Okay. So you also have the other tool you can use of the IRA that's separate from your 401k. So you can max out the IRA then at 6,500. And the Roth, not that it's tax deferred, but the Roth limitations this year are what, 8,000?
I believe so.
Yeah.
Yep. And that they don't provide an immediate tax deduction.
They don't provide an immediate tax deduction. That's the that's the opportunity we were talking about, where if you want the money to grow tax-free later on and you can afford to, then you can pay a little bit more tax now. So something that you should examine as we come up on the end of the year, because you want to get all these ducks in a row and say, okay, what can I put into Roth? What can I afford to? Because just throwing it all into the IRA without a plan makes it really hard.
Right. And if you are over 50 for Roths, you have catch-up contributions that you can make to that.
Correct.
So that's kind of nice too if you wanted to throw a little extra money in your Roths because it grows tax-free. And withdrawals in retirement are also tax-free. So
let's go back to the employer-sponsored plans, because we kind of grazed over this. But maxing out the 401k contributions is ideal, especially if the company is matching you and you can afford to max out the 401k, because obviously you're getting the benefit of that match. Now they have all kinds of crazy formulas that they use now. It used to be, well, we'll match you 4%. Now it's, we'll match you 2.5% up to this point, and then an additional 4 on top of that, and all this other, just kind of encouraging you to put more into the 401k, right?
Yeah. And I see that there's, when I started doing this podcast, Adam, something funny on here that I saw, it's essentially free money.
Yeah.
Which is one of the lies that you talk about in your book.
In
they
the
lied.
book, yeah. Okay, listen, we could have an hour-long debate on this, but it's simple to me. If that employer is matching you and they put $5,000 that year into your 401k, they got a tax deduction for doing that. So they didn't pay taxes on that money that they matched you, right? But when you take the money out later on, you pay taxes on it.
Yep.
So explain to me why that's free. And everybody talks about, well,
they're giving you the match.
They're giving you the match. Then you get all the free years of the growth that's tax deferred. But it doesn't mean that you're not paying the taxes. So how much of that was really free, right?
Right.
So anyway, so we can go on and on about that. But for 2024, I think you already said it.
Yes.
You can contribute to $22,500 or $30,000 if you're over 50. It does reduce your taxable income dollar for dollar. And if your employer offers the match, you want to make sure you contribute enough to get the full amount. Some people, let's say if the employer is matching you 6%, some people will say, well, listen, I'm only putting 6% in because that's my match. If your contribution total that you're putting aside for retirement is 10%, maybe you say to yourself, okay, I'm going to put the other 4% in the Roth then, since they're not matching any more than 6%. The funny thing is now you see a lot of the healthcare systems, what they're doing is they're matching the Roth as well. So now it's really a conundrum, right?
Yes.
Like how much of it do you want tax-free versus tax-deferred? So these are all things that you kind of need to focus on, especially at the end of the year. Not even just the end of the year, going into the next year. At the end of the year, you're going into the next year. So do yourself a favor and start planning for the next year too. Because if you got a raise that year, you can adjust your contributions. If things didn't go as well that year, it's always a balancing act, right? The bottom line is you have to live your life in your lifestyle. And some of us have extravagant lifestyles. Some of us don't, don't smile at me, Lauren. That's not funny.
I'm sorry.
Uh-huh.
All right. So, we kind of beat that to death, but, let's talk about investments.
Well, I'm sorry. I thought it was important.
It is. We're doing this podcast. It is important. Let's talk about investments. What are some tax strategies investors should consider before the year ends?
Well, this is more of a Kurt conversation.
I know, but I thought that, Kurt's golfing today.
Yeah, of course he is. I can do it. Well, he's golfing with a client. So
yes, he is. I didn't mean to sound like he's taking the day off.
He's not just taking the day off.
No,
but
he's networking.
I'm not allowed to golf anymore. I'm horrible, so it holds up the whole time.
You did carry us once or twice.
But that was a scramble.
Yeah,
you depended on my drive for that one. So.
All right, investments.
Tax loss harvesting. That's what we need to remember. It's a powerful tool. So if you sold investments at a loss, you can use those losses to offset the investments that you had gains on. Okay. So just for an example, if you have, let's say, what's a good one here? Let's say Ford. Okay. I don't know.
Sure.
Let's say that you bought Ford and it was really high at one point and now it's down in the tank, right? But Tesla has been taken off, right? So you can take some of those losses, sell the Ford, and it makes up for the capital gain that you had on the Tesla.
Okay.
Right.
Okay.
So if your losses exceed your gains, you can use up to $3,000 to offset ordinary income. But what you want to watch out for is the wash sale rule, and that prohibits buying the same or substantially identical security within 30 days of that sale.
Okay. And I'm sure there's some kind of penalty.
Yeah. So ideally what happens is if you sell Ford and it's really, really, you've taken a loss, but you love Ford and it's going to go back up, don't try and buy more Ford stock until it's been 30 days.
Okay.
Right.
Okay.
And that's actually hit me before too, because I was in and out of Disney and stuff like that.
Sure.
And I did it within 30 days and you get this notice from Schwab.
Oh, gosh. All right. Well, how can investors avoid a big surprise come tax time if they've had a profitable year in the market?
Good point. So if you've had a lot of capital gains, you might want to review your withholding or make an estimated tax payment to avoid the penalties. And you might also want to consider rebalancing the portfolio. It's a good time to kind of align your investments, with your long-term goals while potentially reducing the taxable gains. And the one thing that we talk about is people come in here and they've been so used to growing that money. We haven't really thought about what our goals are at this point. Right. So it's a good time to start thinking about those goals, what you really like to do.
And your goals can be anything. It could be taking a vacation. It could be, remodeling the bathroom. These aren't like, they don't have to be huge goals, but it's something that you want to get done every year, right? Something that you almost like a bucket list maybe too, right?
Well, we all have goals while we're working too. So like for me, within the next 2 years, I'd like to build the house that I want, that I want my family to grow up in. I'd like to do that. I have a nice house now, but it's not my like custom dream big idea. Kelly wants that big, 20 by 20 closet.
Oh my gosh. Yeah.
I don't think it'll still hold all of our stuff. I love you, honey. Anyway, you have to have similar goals when you retire, because if you think back, you had these types of goals and retirement was one of those goals.
Sure.
But we never stop to think, okay, what am I going to, you always think about it. Yeah, I'm going to travel. I'm going to do this. I'm going to do that. But for me, when I retire, if I have my house, maybe I just really don't like the windows anymore.
Right.
It could be as simple as, doing new windows, doing a new roof, remodeling. Finally building that pool you want.
They're big expenses, but, with the right plan in place, hopefully, you find somebody like Evolution Retirement Services or us to help you achieve those goals.
Yes. That's my favorite part of the job.
Yes.
Is convincing people to loosen the purse strings.
I was going to say, sometimes, I would say, 8 out of 10, you're telling people to spend more money.
Well, actually, I stopped saying that, because you say that to a baby boomer and it's like, oh my, and they're already on the edge of their seat.
Right, because they've been savers their whole life.
So what I try to convince people to do, and this is a much softer way of saying it, and it's probably better because it's the truth. Start, rather than investing in the stock market and continuing to invest in the stock market and growing your money, how about preserving some of that money and starting to invest in experiences now rather than investments, right? So that's
a nice way to say it. I like that.
Invest in the experiences that you want to have.
I'm going to use that next time I ask Kurt for a vacation.
No, that's not going to work.
What?
Amber's already out on maternity leave.
Oh my! I'm not saying it'll be yet tomorrow. I'm just saying, I'm going to use. Hey, Kurt, I'm investing in experiences.
Yeah, it's time to invest in some experiences.
But so anyway,
you know what he's going to say? Don't you need money to invest in those experiences?
Oh God! And
Don't you have to work to get the money?
I'm going to say, Kurt, it's time.
Yep.
Anyways,
I get it.
Let's touch on gifting.
Ooh, I
and
like that.
Estate planning, which we've talked about in our last 2 podcasts. But are there any year-end moves that can help listeners reduce their tax liability while helping their families?
Yeah. So, and it's not just helping their families, right? Like, guys, we just want to make this abundantly clear. If you feel the need to gift Lauren or I something, it's still the same. I'm just kidding. All right.
You are a gift, Adam.
So, first of all, absolutely. There's a lot of stress. So you can gift up to $17,000 per recipient without triggering gift taxes. And that's $17,000 so each married couple, right? So the husband and the wife can each give $17,000.
Right.
So they can give $17,000.
So $34,000 a year.
Yeah, total between the married couple, right? And you can give that to pretty much as many people as you want. It's a great way to reduce your taxable estate while you help your loved ones at the same time, right? Because your total gift allowance on your taxable estate for this year is $24 million, right? So it's $12 million.
They're changing
per person.
That though, right?
We don't know what's going to happen. It's written down that it's supposed to drop to $6 million per person.
Yeah.
So instead of $12 million per person, it's $6 million. I'm just going to assume that that's going to happen. I mean, that's what's in writing right now. Hopefully things change, but it's a good time to really help your family out and take advantage of seeing it, right? Rather than just knowing that you're going to leave them, $1 million bucks, right?
Sometimes it's nice to watch people, kind of enjoy it while you're still around, right?
Yeah. And as far as the kids and the grandkids go, so if the kids are younger or if you have young grandkids, if you're planning on education expenses, you could consider contributing to a 529 plan. And a lot of the states offer tax deductions or credits for those types of contributions. And the earnings grow tax-free if it's used for a qualified education expense. Now, that doesn't include college anymore. That includes trade school, things like that. So it is still tax-free. The one thing I would urge, grandparents and parents to look at as well, for me, this was one of the best case scenarios for me. As soon as Maverick and Scarlett were born, I signed up for the Florida prepaid plan.
Oh yeah, my parents did that for
$138 a month for tuition, room and board. So what you're doing is you're prepaying today's cost of college.
Right.
So when you go to have the kids go to college as long as it's in the state of Florida, right? Mm-hmm. That's the only drawback to it. It has to be in the state of Florida. Because if you do end up not using it for college and you cash it out, a lot of people don't realize you're cashing it out for today's value of what college was. So if college is twice the amount later on, you don't get twice the amount. You just get what you put into it.
Sure.
Right? So it's still there. It's just, there are some drawbacks to that. But if you do believe that, your kids could potentially end up in the state of Florida going to school, or in the state of Minnesota, whatever it is, every state has some sort of a prepaid plan. So it's something else you can look into.
Okay. Well, Adam, let's kind of wrap this up, and let's end it by talking about deadlines. What should listeners prioritize before December 31st?
I'm glad you said deadlines, because it's crucial. I mean, you got to know when it comes up. So deadlines for most strategies like charitable donations, 401k contributions, tax loss harvesting, everything we just talked about, you have until December 31st. IRAs give you a bit more leeway with contributions allowed until April 15th of the next year. But don't wait. Start now so you don't risk missing out due to year-end processing delays, things like that. If you tell somebody you should get it done by December 31st, but you really have until the 15th of April, what are they going to do? Right? I mean, everybody's going to take their time. Try not to drag your feet on it, especially because most of what you need to get that done is based on what you earn this year, right? So get it done. I mean, you already know it's not going to change between now and April 15th.
Yes.
So
and I know for our families at Evolution, we make sure everything is wrapped up, your RMDs, any Roth conversions that you might have towards the end of the year, just so that your tax plan is ready and you know exactly what you've spent for the year. It's nice to wrap that up towards the end of the year so that there's no surprises. But any financial tips, Adam, for listeners as they tackle this year-end tax planning?
So many families, before they work with us, families that we meet with, think that when they talk about paying a professional or paying for the help, they think that they're working with a professional that's going to help them with their investments. And that is absolutely not true. Now, that does happen in most cases. You're working with somebody, you're paying a 1% fee, and they help you grow your investments. When you hit retirement, though, you need the specialist. You can't go to the general practitioner anymore. So when we talk about working with a professional with us, it's what we do with our families. We have 2 CPAs, 2 estate planning attorneys, and advanced tax planning estate specialists that helps us with just that. We also have Medicare specialists. Basically, if you're paying a fee, you should be getting all of those services in retirement. And when you're not, we start to tell ourselves, well, I don't need this or I don't need that, but you will. I mean, that's I can't say the word guarantee because I'm a fiduciary, but in most cases, you will need the help. These problems will hit you at one point or another. So you can pay, and you can actually pay a fee for all-inclusive service, or you can continue paying a fee to the financial planner who really doesn't have a lot of expertise with guiding people through retirement when it doesn't come to the investments. So I think when I say you should always work with a professional, you really need to. And the thing is, tax laws are complex, right? Having an advisor or CPA review your situation helps you avoid a lot of costly mistakes, especially when it comes to taxes. And remember, tax planning is part of a larger financial strategy, right? So even though you're saying to yourself, well, I already pay somebody for my investments. Great. What did they tell you about taxes here? What about harvesting your capital gains? What about what your estate looks like 10 years from now? It's just all.
And those align with your long-term goals a lot of the time.
Exactly.
Too,
Exactly. You have to be ready to talk about those because nobody likes talking about them because now we worked all this time. We're in the golden years, right?
Yes.
But what happens after the golden years? Mm-hmm. We die, right?
Yeah.
We die in the golden years. So it's kind of like, we don't want to talk about this.
Yeah.
So.
Well, thanks for breaking all of that down for us, Adam. I do want to talk about some events we have coming up here at Evolution. December 18th, that's our Lunch and Learn. Matt Stoll from First Trust will be speaking about the latest market updates. We're also doing our Christmas party January 8th at the Broadway Palm Dinner Theater. We have already 200 people registered for that. I am going to stop taking reservations very soon. So if you have any questions about that, let us know. And in January, we do have a couple Broadway Palms. That's where we do our workshops at night.
Let's go back real quick.
Mm-hmm.
The Christmas party is for our current families.
Yes, that's for our current families at Evolution.
So I think what you're saying is if you're bringing a friend.
Yeah, any family members or any of our families at Evolution, if you have somebody that you want to bring, just give me a call. But yeah, the January events, they're going to be towards the end of January, the 21st, 23rd, and 29th.
And that's for everybody.
That's for everybody. I try to say it's for first-time attendees only. Sometimes, you have a friend that you might want to bring if you're a client with us already and, give hopefully somebody who needs our help. They can come and see the workshop and enjoy dinner in the show. And then we do have another workshop that is kind of special. It's at Marina Bay. We have some families that asked us to do a workshop in there.
Allison.
Yes, Allison, we love you. And so that's going to be really special. But, I just want to tell everybody happy holidays. Thank you so much for trusting us and being a part of our family here at Evolution. We love you all very much. And it's been a pleasure. It's been a pleasure to serve you again.
You know what's nice about us is we don't have the family drama when we talk about our families.
Our families here are just absolutely incredible. I love each and every one of you. And,
Speaking of which, I'd like to get a weigh in on this.
Okay.
I'm planning, you know how I get. I love Christmas because Austin comes in. Amelia's there. The kids are there. My mom and my stepdad come.
Yep.
I'm trying to figure out, usually every year, Kelly's mom does this big spread, right? And it's great. We just had Thanksgiving. She makes the Jamaican dishes, the American dishes. I'm having a hard time with this, and I've kind of Googled it and researched it. Is it turkey or ham at Christmas?
Ham.
That's what I think too. I get a honey baked ham and I bring it over for Thanksgiving.
Yeah. Ham, lasagna. Those are Christmas meals to me.
Yeah.
But,
yeah, right. I mean, I that's what I want to see too. I think I'm just going to do ham. I don't want to do turkey's Thanksgiving, right?
Yeah.
We never get that right. It's always like, I wish it was a little more.
I think ham, lasagna, stuffed shells, something like that. That was always our thing growing up,
Stuffed shells.
Oh, yeah, so good.
The cheese spills over. Good. It is good. Yeah, I think I'm going to go with the ham though. I love my honey baked ham.
I know you do.
What's funny is Scarlett was up last night again, and she always finds a way to weasel her way into bed with me. And she's having her little juicy bottle because she's thirsty. And she said, Dad, a Peppa Pig, because, she likes to watch Peppa Pig on TV. Turn on the TV, Peppa Pig. I'm like, no more Peppa Pig. She's like, no more Peppa Pig. I said, no, we had Peppa Pig at Thanksgiving.
You did not say that.
I didn't say it, but
you are the worst. Oh my gosh, that poor little girl.
I told her Peppa Pig was sleeping.
Okay.
And then I said, in my belly, as soon as that was, I didn't say that.
All right, so we're going to wrap this up. Thank you guys so much for tuning in to the Retirement
Wait a minute.
Evolve
I wanted
podcast.
to ask you something else.
Go.
So Nola, Dolce, Coda, all of our animals, right?
Yes.
You know this, and I think some of our families would like this too. Where do you take the pups for a picture with Santa? Did we figure that out
Bass
yet?
Pro Shops.
So Bass Pro does that? But see, here's the problem. Then you get a bunch of animals running around.
Yeah,
right?
I mean, you've got to have a dog that's well-behaved.
He's well-behaved. He's misunderstood. He's still in trauma from being at the shelter.
Well, anyways, thank you for tuning in to the Retirement Evolve podcast. Don't forget to subscribe, leave a review, email us at info@evoretire.com, call us 239-771-8696, download the book, They Lied, The Real Cost of Your Retirement at taxfreefortmyers.com. Spell it out, tax-free Fort Myers.
How are we doing on the new book? I know we're waiting for the publisher to send back the first draft. Speaking of dogs.
Yeah, Nola's
Dolce.
Here. It's Nola.
It's Nola. Yeah, sorry.
Nola, I had to bring Nola to the office
Nola's
today.
here,
All right. Well, thank you, folks.
See y'all later.
Bye-bye.
Investment advisory services are offered through Evolution Wealth Management Incorporated, an investment advisor registered with the state of Florida. Registration does not imply any level of skill or training. Evolution Wealth Management's unique CRD number is 307644. You can obtain a copy of Evolution Wealth Management's firm brochure, Form ADV Part 2A, free of charge by visiting advisorinfo.sec.gov. Evolution Wealth Management offers investment advisory services only, where it is appropriately registered or exempt from registration, and only after clients have entered into an investment advisory agreement confirming the terms of engagement and have been provided a copy of the firm's ADV Part 2A. Insurance services are provided by Evolution Retirement Services. Any guarantees mentioned are backed by the financial strength and claims paying ability of the issuing insurance company and may be subject to restrictions, limitations, or early withdrawal fees, which vary by the issuer. They do not refer in any way to securities or investment advisory products. You should consider the charges, risks, expense, and investment objectives carefully before entering a contract. This material has been prepared for informational purposes only and should not be construed as a solicitation to affect or attempt to affect either transactions in securities or the rendering of personalized investment advice. This material is not intended to provide and should not be relied on for tax, legal, accounting, or other financial advice. Evolution Wealth Management and Evolution Retirement Services do not provide tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Evolution Wealth Management and Evolution Retirement Services are affiliated entities.